Okay, great stuff. We've now come to the accounting part, the numbers part. This part, we translate all the qualitative factors, all those stories we had, the idea, we put it now into numbers. We understand we start off with the customer segment. Remember the customer? Customer comes first. Without revenue, you don't have a business. To understand there is a market for your business. Now what the income statement does is, we're going to start with the income statement. This is also known as your profit and loss. It basically takes all your income and expenses. We'll start off, I'm just going to quickly go through the brief overview of how I went through, or we're going to go through the income statement. We see the four components of the income statement. The first part starts with your sales. Then comes your cost of sales, which is also an expense basically. Then comes your operating expenses or your operating cost, which is your second part of expenses. And then comes your net profit and tax and profit or loss after tax. Now, those are the four components which I like to split a income statement. The second part is we're going to go through the actual of what you actually incurred, and then the future or forecast, which I'll explain later. So this is the structure of the income statement. And this structure can be found on the download link on my website. So on our website, you can download this thing on Excel, and it will give you a pinpoint on how to complete it using the training available. Now, as you recall, we completed our business plan. We took our business plan and we defined our customer, and we saw how we're currently obtaining customers and what type of customers we're going to get in the future. So to start off with, we're going to translate the customer segment. We're going to translate that to a number. Now this number will be a monthly amount. So I'm going to use here monthly, just to take note that everything should be done monthly. So your actual per month, you could either use your previous 3 months, so you might have more columns, but we just go at per month. So we'll use the last month, or you can use a monthly average. But I prefer using the latest month that you have. So let's take an example of a business that is selling handbags to the boutique store and hats to the boutique store. Let's use that one as an example. That's a nice example. So to start off with is, we're obviously going to get revenue. The business is going to generate revenue. So with that revenue, we're going to translate that revenue into the amount of money we received. That's the amount of turnover we received. So on a monthly basis, let's say that this one got 100,000. And to keep it simple, I'm not going to use VAT. So there'll be no VAT in this example. Once we got all the actual values inside, we will then go to the future values, and I'll explain more about what the future values are. Now we've got the amount of sales that the boutique supplier, we're supplying the boutique stores. We understand the business model, and we saw that in the previous month we made 100,000 Rand in sales. So that was selling hats and selling bags. Perfect. Now we have to determine the costs associated with those sales. Now the costs are split in two. Costs are split in what is actually in the product, so the product cost of the product, and that is known as cost of sales. And the second part is the operating costs. If you can split those two, it gives you a better understanding of where your costs lie. Now, if you were in the egg industry and you had to buy and sell eggs, the cost of buying that egg will be part of your cost of sales. That's your product cost. But in our case, we are manufacturing the bags and we're manufacturing the hats. So in our case, the materials that go into the manufacturing process will be part of our product cost. Now, let's assume that it costs us in material 10,000 Rand, and some miscellaneous items like the sewing material, the cotton, and the various feathers we might have, all those product costs comes to, let's say, 15,000 Rand. So we'll put 15,000 Rand as a cost. Now, if that's 15,000 Rand as a cost, we come to a number which is called gross profit. Now, the gross profit in this case will be 85,000 Rand. Now, what's important about the gross profit is your gross profit is the amount that remains after you paid for your product cost. So in simple terms, this determines if the product you're selling has actually got value. If you're not making a profit on this line, there's no way you can have a business that is sustainable. Now, that's the reason why we split the two costs. If you can deduce in your own business what goes to product and what goes to your actual costs, and you can split those two, you can actually see if you have a business that's reliable and is able to sustain you. Now imagine this figure was a negative. You all agree with me, if this figure was a negative, whatever I do in my normal operating side of the business, no matter how efficient I make it, I don't have a viable business. Now, a simple example, maybe a stupid example, but let's talk about it. Imagine the cost of of building and making this hats was more. The costs, and you collected all the invoices you got from your purchase material was more. It'll be pointless having a business. So I advise you, if you're selling eggs or whatever type of market you're in, if it costs more to make the product, no matter what you're doing efficiency-wise, you're not going to make money. And you can't simply say, oh, you know what, my costs are a certain amount. Let's just say, in this case, the cost of the product was 120,000 Rand. Oh no, I'm not going to make money at 100,000 Rand. I must now charge 150 to 160,000 Rand if I sell a certain amount of products. This way of thinking also might not work, because you have to determine what the price point is in the market. So in the case of the hats, if you sold 1,000 hats a month and one hat was, let's say, $100, and so you're selling 1,000 hats at $100 each, gives you 100,000. You're doing your costing, it's fine, it makes sense. But if the hat costs you 120 Rand to make for one hat, and you're only making 100,000 Rand from those 1,000 hats, can you see you're not going to make profit? And to make a gross profit of 150, you'll have to charge 150 Rand for one hat. But now if the hat can't be sold at 150 given the price point of what the other competitors are in the market, or maybe your brand is not yet established, you won't be selling any hats because it's overpriced. So that's the important part when it comes to gross profit and the relationship between your revenue, your sales, and the product cost that you incur in your operation. So that product cost has to be costed on the materials and the cost of the actual product. That gives you your gross profit. So that's the important part of that number there called gross profit. Now we come to the third part, and the third part I believe is your normal general overheads. These are overheads we're all familiar with as a business owner, and this translates, remember the resources we spoke about? So we spoke, you got this access to resources in your business plan. You maybe got office space, you maybe have staff, remember the 5 or 6 staff you have in your business. So these resources, this is where you capture the costs of maintaining and having those resources and having those channels. So if you have a channel of delivery, you maybe have a channel of a delivery, that's your vehicle cost over there, or delivery costs, you'll put those costs there. And rent, you've got access to maybe a warehouse where you can store the bags, or the business premises you're working with, where you actually maybe manufacturing the bags. All of those things will have a cost associated with it. So you'll put all these costs on a monthly basis. They're normally fixed. There might be a little bit variation between electricity, and you'll put all of those costs in its relevant format, and then you'll come to maybe a total cost called operating cost. So I'm not going to go through each one. I'm just going to assume a total cost for all of these under operating cost, and I'll call this, maybe let's call it 45,000 Rand. How does 45,000 Rand sounds fine? So we'll put 45,000. Now we come to the next figure down here. If all the costs and overhead costs comes to 45,000 Rand, we're going to come to a net profit in this case at 40,000 Rand. Okay. Now if you come to a net profit of 40,000 Rand, you can understand that this business is sound because it is making a profit. Basically, it's taking its total sales minus its total expenses, both cost of sales and operating, it comes to a net profit of 40,000 Rand. So in that case, if you look at it at what one-dimensional view, it's making a profit. But then there's other questions to ask. And these questions can only be answered once we have the balance sheet. And that's where the balance sheet item comes. Okay, now that you understand the structure of the income statement and the four components that I like to, four elements of the income statement, and you understand that you're going to be capturing your monthly, or in some cases, the annual amount as a total. So if you've got 12 months, you'll have your annual amount, or your monthly average. Those are the three things. So let me just write it down. So you got to, so I can discuss it a little bit more, because the way you do your actual will actually affect the way you do your future. So I got the four types. I said three, there's actually four types. I'll get into it of how I deduce the four types. I believe the best way to do it is to do it on a monthly basis, and then once you got your monthly amounts of your actuals over a 12-month period, you'll total all those 12 months up and you'll come to an annual amount, which will be your yearly amount, the total for the year. Now the total for the year is the best value you can get, because that's everything. Okay, but if you don't have a full year, like many small businesses that maybe only operated for the first 6 months, or they only operated for 9 months, what's the next best way to do it? So yes, you're going to have the monthlies, but the way you do your monthly, especially the first few months in your business wasn't very active, it's going to affect your future forecast, the budget. So think of the future as the budget, and also think of the anticipation of those figures based on your assumptions in your business plan. So putting all that together, we come to the future. Now it's very important that we understand the numbers we're working with. Now we can work with monthly, as we spoke earlier. We can put every single month, and then we will come to an annual amount. So think about it. If you're going to take all the monthlies and you come to 12 months, you're going to have a full year. That's best case scenario. If you don't have a full year, you can do an annual equivalent. So in some cases, let's say you only have 6 months. So you can say 6 months actual, and then you can maybe times it by 2 to create a full year. So you got a year as a thing. That's just something you can do, but you have to state that in your assumptions that this is the way you did your actual. So you still have your actual of the 6 months, but then you'll have a extra column showing actual annual equivalent of what it should have been had it been 12 months. Another way to do it is to go through a monthly average. Now the monthly average is not something I would recommend because it's really got assumptions. That would be if you've got like a very unstable type of business which has got revenue a lot in the 1 month, especially if you're using like the amount of cash you got in from the business, and you may be building a machine that takes 3 months to build, and you know it's like no income for the first 2 months, and then in the third month you make a huge amount of income because that's the amount of cash you collected in the bank. In such a case, it might be recommended to give a monthly average. Okay, but you need to go much more in depth in this. If you need help regarding this, I suggest you email me, because to go through all these concepts can take some time. But to understand the basics, keep it at a monthly actual and total up to an annual amount, which is a full year. Now that you've got the actual amounts and you put in the net profit, you spoke to a tax practitioner or you looked up online what's the tax rate, we're going to assume a tax rate of 28%. Please note this is an assumption. Most small business won't be paying 28%, they'll be paying much less. There's different sliding scale brackets. I mean, you can even pay no tax when it comes to corporate tax if you're under a certain net profit amount. Okay. If you made a loss, obviously there won't be any corporate tax. So there'll be no business tax if you made a loss. Okay. So I'm just putting that, but you have to at least showcase and show what your profit is after the tax. Okay. Cool. Now we got the actuals in. We understand the elements of the income statement. And we now want to project, okay? We want to project what's happening in the future. What's our future budget like? Now, if you're asking for funding, think about it. You're asking for money. Now, if you're asking for money, you need to have a money or figure in mind of what you're asking for and justify why you're asking that figure. That is why the concept of the income statement and having your forecast and your future budgets accurate as best it can be. Okay, it's not going to be perfect because it's an assumption. If the more accurate you have this figure, the more assumptions and you can actually back it up and the numbers make sense, the better the chance of you obtaining the funding.